The Money Show. Personal finance.
In our personal finance feature this week, of course, Warren Ingram joining us on the line, personal financial advisor and executive director at Galileo Capital. Yes, we entered 2020, as some may say 20 plenty and the likes, but where should you be investing your money for the next decade? Warren, this is the type of stuff you see in a crystal ball, sort of getting into the future here.
Exactly, and I think the nice thing about looking at a period like a decade is I think it's a little bit easier to be right about investment predictions than if you were trying to make a prediction about what's going to happen in the next year. And the reason I say that is, markets move in long cycles, somewhere around 7 to 10 year cycles, and so what I did was I looked back at the last decade to see what had done really well, and potentially what had done quite badly, and the reason I wanted to do that was because actually something that does very well over a decade in investment markets has never repeated the same feat in the next decade. So if we look at the 2010s, it was definitely America's decade, and in fact it was the era of big tech companies basically, and they absolutely dominated, and so much so that they probably did about 2 to 3 times more in growth than what South Africa did over the same decade, and certainly what emerging markets did. And I think for me that's the starting point of looking at the next decade, because when emerging markets as a whole do somewhere around 4% a year for the last decade, and South Africa's slightly higher than that, but not much, then we know that maybe it's time to start looking at emerging markets again.
Are emerging markets still the actual flavor, though? And I mean, I ask that because maybe I'm just looking at South Africa on its own, but really the growth rates have not been too phenomenal, particularly over the last 2-3 years or so. So that becomes difficult to really entrust. But as you say, it is a decade. So it perhaps does give you a little bit more leeway. Are emerging markets still the flavor if you're willing to take on the risk?
I think it's you can't say it's a racing certainty. I think that would be silly, but I would say that there's a very good chance that certainly is the case. And I think eventually, the version of physics and the version of gravity in investment markets comes down to the size of your economy, the size of your population, and then very importantly, how productive is your population, and how educated and how hardworking are they. And so when we look at emerging markets, they've got the right mix in their demographics compared to developed markets. So, if we just looked at, for example, China and India, on the one hand, and you compared that to, let's say, Western Europe and Japan on the other side, you would look at those and you'd say, well, Western Europe and Japan, their populations are actually quite old already, and they're certainly not having a lot of children, and so what you're finding is that their population pyramid is becoming very top-heavy, with lots and lots of old people who are living a long time, but not necessarily generating income, and then very few young people that are coming into the workforce that are able to sustain the needs of the older people. Contrast that with China and India, where you've got this really highly educated and growing population that is really hardworking, and then in percentage terms, quite a small part of the population is older, and so they are the ones that will be growing their economy and buying a lot of stuff and making a lot of stuff, and then looking for things like cars, for their own accommodation, cell phones, and then eventually hospitals, schools and the like, and that's what will drive stock market growth. And I think so if the 2010s was America's decade, it's very unlikely that America carries on growing like it has. I think their population, if you look at the things like their maths literacy, their science literacy, their research and development, they're falling rapidly behind the Chinese, as an example. And so I think it's really going to be around the whole growth of the economy moving to Asia. And so definitely, I think emerging markets is certainly going to be one of the big themes of the next decade. And we shouldn't get too fixated on what's happening in South Africa and then say, well, that's the picture for all emerging markets. I think that's not accurate.
Yeah. Okay. So where exactly? I mean, you've noted quite a few places to kind of look at, particularly the Asian markets and the like as well. You did mention as well the JSE doing around 11% a year over the last decade, listed property doing about the same. Cash had only given you 6%, which still would have been sufficient growth. But where else can we sort of look at now over the next decade?
Well, I think, one of the things I've learned about investments over the last 20 years is never be too specific when you make a big investment call. In other words, if I'm saying that I think emerging markets is the place to go, and I'm not sure that, that the US is going to continue, that doesn't mean that you sell out of all of your American exposure and put everything into emerging markets. I think that's a very risky strategy. And, the one thing about, markets, they do keep us humble. So as soon as we feel like we've got a grip on what's going on, markets will surprise us all and do exactly the opposite of what was anticipated. So I think, as a starting point, I would always, if I'm going to invest overseas, always have a big global exposure. Try and look at, if you look at the world index, that's a good starting point, which at the moment does have quite a big exposure to America, probably about 55%. And so, if you're investing in the world, then what I would do is say, if the world index is at 55% in America, maybe reduce that. Maybe go down to sort of 40 or 45% and reduce your US exposure, increase your emerging market exposure. I think that makes a lot of sense to me because that is the growth. And then I'd be really careful of buying bonds in the US and especially in Europe and the UK and Japan. I think the one most expensive asset class in the world right now is bonds being offered by the developed world, because at the moment you can buy an inflation-linked bond in America for 10 years where you will get back exactly zero on your money after 10 years when you take the impact of inflation out. In other words, you just get no growth. The buying power of your money stays exactly the same, and you've locked it away for 10 years. You can buy a Swiss bond for, I think, 30 years, and they will guarantee you 0.75% a year less on your money for 30 years. So we're in a really strange place in the world bond markets at the moment where interest rates are actually negative. It's almost like going to the bank and saying, I'd like to do a 5-year fixed deposit, and the bank says, sure, we'll give you back 10% less than what you gave us at the start because we're going to charge you interest to give us a fixed deposit. It doesn't make sense. And so I'd be very careful of government bonds around the world. I certainly would look at emerging markets very favorably, but potentially more around Asia, and from India across Vietnam through to China. I think that is the growth engine for the next decade. But then that doesn't mean that you ignore the JSE, for example. Our market is so cheap now and has been so depressed for so long that even though we had a good year last year, I still think that there's a good chance that we get somewhere around 10 or 12% a year from the JSE over the next decade. But of course, it's not going to come in a nice smooth line. It's going to come in big jumps and big drops again. But over the decade, I wouldn't be surprised if we still get at least, as I say, 10 to 12% a year. So definitely look at the JSE as well, but then significant emerging market exposure.
Yeah, so as you said, give it time, be patient. Don't just think it's just going to happen over its own, on its own, or without having to sort of wait it out, right? And actually be patient in and around it. One of the things, like, for instance, the local tech stocks or tech plays, shall we call it that, Naspers, the questions have always been around the valuation of Naspers right now, trading at somewhat of a discount. Do you look out for stocks like that? Are those the exact same ones you sort of have to go towards and say to yourself, yep, I need to try and find a little bit more of those? Are there any of those opportunities, you reckon? Or is it just going to take a whole lot of, proper research, really getting into the discussion points with a whole host of these people in order to try and find the right one?
Yeah, I think I'd be very careful when you're looking at emerging markets to take very big bets on only a handful of companies. I think something like Naspers, via their holding in Tencent, has done incredibly well. But it takes a bit of luck to be able to predict that and to find that one share. So what I would rather be doing is actually buying a couple of the indices around emerging markets. So look at a sort of a more generic emerging market index, because I think that at least if China goes through a bad patch, it could easily do that. If you look at just what's happened to the world stock markets in the last couple of days, where they've got this new flu virus that's really affecting at least sentiment at the moment, maybe not the economy just yet. And something big like that could just set people back over a year or two. So you don't want to be too specific in just buying 5 or 6 shares in China and saying, okay, well, that's my emerging market exposure, I'm done now. I think rather say, let me get there's lots of these exchange traded funds that have that are pure emerging market funds, and I think that to me is quite a nice call. If you're going to look at companies that do profit in emerging markets, I think you probably want at least sort of 20 or 30 in your portfolio, not 5 or 6, because some of them won't work out, and we'll be surprised. If you look at something like Chevrolet, they make and sell more electric cars in China than they do in America. So that could be a play, but I wouldn't want to do just 1 or 2 shares.
Yeah, you certainly have to get really stuck in if you really want to find the value, I suppose, in all of these. Warren, thank you so much for the time, though. Really appreciate it. Warren Ingram is personal financial advisor and executive director at Galileo Capital, having joined us on the line there.